Today, we're zoning in on a huge name in the AI hardware world, supermicrocomputer, or SMCI. This stock has been, well, a roller coaster. We've seen these massive highs and then some really steep, pretty brutal corrections.
It's been a wild ride, for sure. And that volatility is exactly why this new analysis we found is so interesting. The report we're diving into makes a really bold claim. It says that after this significant and painful pullback, the stock is showing clear signs the correction is over.
And the thesis is strong. They're basically calling it the biggest buy-the-dip opportunity of 2026.
That's the headline.
That's a huge claim. And if you've been watching this stock, you know how fast things can turn. So our mission today is to really scrutinize this bullish recovery report. We need to go past the headline and look at the actual evidence.
Exactly. What are the signals? What's the data?
What technical signals are they seeing? And what fundamentals are there to back up the idea that the business is ready for a huge reversal? Basically, we need to know, has the bleeding actually stopped?
Absolutely. When a company's moving this fast, the data has to be rock solid. We're looking for that perfect storm, really. Confirmation on the charts and strong fundamentals under the hood. The core argument here is that the market just got the risk wrong.
Okay, so let's unpack that, and let's start where the analysis does, the charts. This whole recovery idea is built on what they're calling the $30 floor. And it's not just a random round number, right? There was a specific event.
It all comes down to one moment, really, a single day, January 9th. The report points out that SMCI dipped, and it dipped hard, all the way down to $29.55. So for a minute there, it was trading below that huge psychological $30 level.
So the market was testing it, poking it to see if there were more sellers down there.
Precisely. And what happened next is the key. Instead of just continuing to fall, there was this immediate, really powerful snapback. Buyers just flooded in, rejected that lower price, and drove the stock all the way back up to close above $30.16. That bounce is the signal.
Okay, so that sounds like a technical thing, but let's break down why that's so important for people who read charts. What does that snapback actually mean?
The analysis calls it a classic rejection of the lows. You have to think about how big money, like institutional funds, operates. They often have massive buy orders sitting around these critical price levels. So when the price hit $29.55, it was like it ran into a brick wall of buyers.
So that bounce is basically proof that the big players are stepping in.
That's the interpretation, yeah. The report sees it as a clear sign that institutions have drawn a line in the sand. They're saying, we will not let it fall below $30. This is where we buy.
And that turns the $30 mark from just a number into a strategic battleground. The analysis even calls it a technical fortress.
It does. And it's not arbitrary. If you zoom out a bit on the chart, you see that for weeks before this, the stock was just consolidating. It was stuck in this really tight range between about $29 and $32.
So the market was just taking a breath?
Taking a breath, building energy. Technical analysts see that kind of low volatility, sideways movement as a coiling spring. The pressure is building up.
I see. So it's compressing the energy, not losing it.
Right. And here's the key technical insight for you. When a stock tries to break down from that range and it gets violently rejected like that, it's a huge signal that the path of least resistance has probably shifted. It's now pointing up.
Because it had its chance to fall and it failed.
It failed. And now all that energy that built up is expected to push it higher, provided, of course, that the $30 fortress actually holds.
So the chart looks primed. Technically speaking, recovery mode is on. But if the business is crumbling, none of that matters. We have to shift now from the charts to the fundamentals. The reasons this analysis thinks the stock is just, well, too cheap to ignore.
You need that fundamental support, or the bounce is just noise. And the report lays out two massive arguments that suggest the valuation is way behind the company's real growth.
Okay, let's hit the first one, the valuation discrepancy. What are the metrics that are screaming undervalued here?
The main one they cite is the price-to-earnings ratio, the PE. SMCI is trading at a PE of just 24.35.
Now that number, on its own, it might still sound high to a traditional value investor.
For sure, but you have to look at the context. For a company in the high-growth AI infrastructure space, 24.35 it's remarkably low.
And this is where the comparison is so important, right? Because a PE of 24 is one thing, but what are its peers trading at?
Exactly. And the report makes a big deal of this contrast. High-growth AI stocks, the ones actually building the plumbing for this AI revolution, they're often trading at 40 times earnings, 50 times, sometimes even higher.
So the argument is you're getting similar exposure at basically half the price.
That's the argument. The market is putting this deep discount on the stock that doesn't really reflect its future.
Let me just push back a little on the analysis, though. A PE of 24 is still high for a company that just had a revenue miss. I mean, that spooks people. Isn't that discount justified?
That's a great question, and the report sort of anticipates it. The reason SMCI has historically been cheaper is because of its reliance on partners like NVIDIA and its volatility. But the analysis argues that SMCI's liquid cooling tech is so specialized, so essential for these new AI data centers, that the market needs to start seeing them as a specialized provider, not just a hardware assembler.
That does strengthen the case. And the report also mentioned something about how the market is looking at its sales.
Yeah, they look at the price-to-sales ratio, or PS. It's around 0.85. And for you, the listener, a PS ratio under 1.0 is something you really want to pay attention to, especially for a growth company.
So what does that mean, practically?
It means the market is valuing the entire company at less than its annual revenue. For every dollar of sales the company makes, the market is only valuing that dollar at 85 cents.
So why would the market be so negative on actual real revenue?
The analysis says the market thinks that revenue is about to fall off a cliff. It's pricing in a major contraction. But the report's counterargument is that this is a complete misread. Which brings us to the second fundamental point. The demand is not slowing down.
Let's talk about that demand, because that's everything for a growth stock. What does the report say about the health of SMCI's core business, those liquid-cooled racks?
This is reason two. The AI backlog and the certainty of demand. The report is crystal clear on this. The demand for their high-density, liquid-cooled AI racks, especially the ones built for NVIDIA's new Blackwell chips, is not slowing down at all.
They say it's accelerating, actually.
It's accelerating,
Yeah.
which is critical because you remember the stock pulled back because of that revenue miss. A miss signals trouble.
So how do they explain that? How do you have accelerating demand but a revenue miss?
This is probably the single most important point the report makes. It tackles the miss head on. And it defines it not as a demand problem, but as a supply chain hiccup. And that is a massive difference.
Okay, let's pause on that. A hiccup versus a structural flaw. What's the real-world difference?
A structural demand problem means customers are going elsewhere, or they've decided they don't need your product anymore. It means the business is cracking. A supply chain hiccup is temporary. It means you got all the orders, but maybe a single tiny component, like a special valve for the cooling system, was delayed from a supplier. The demand is there, the money is there. You just couldn't physically ship it out the door in time for that specific quarterly report.
So the bet is that all that delayed revenue just gets pushed into the next quarter. It wasn't canceled.
Precisely. And the company's own forward guidance backs up the hiccup story, not the slowdown story. The projections are aggressive. They expect revenue to jump back to somewhere in the $10 to $11 billion range for the next quarter.
And if they hit that, it proves the miss was just a timing issue.
It retroactively validates the entire thesis.
Wow. So it's a complex picture. We have a technical floor at $30, a deep valuation discount, and this huge projected revenue jump. So now let's get to the so what. If this analysis is right, what's the payoff and what's the risk?
This is where you get the risk to reward ratio. On the upside, the average analyst price target they cite is $46.71.
$46.71 from around $30, that's a huge potential move.
It's massive. That's about a 54% potential upside. And the report isn't just leaning on that one number. It says even their most conservative models see a quick move back into the mid-$30 as soon as it breaks out.
Okay, that's the reward. But every strategy needs an exit plan if it goes wrong. What are the key price levels that either confirm or invalidate this whole idea?
Two boundaries. You need to watch two numbers. First, the confirmation signal. The real green light, according to the analysis, is a decisive break and close above $32.
$32, which was the top of that consolidation range we talked about. Breaking that is like the spring finally uncoiling upwards.
Exactly. It means the stock is officially out of that sideways channel and on an upward path. The second number is your risk management, your stop loss. The analysis is very clear. You put it just under $29.
So if it breaks below $29, the trade is off.
The thesis is invalidated. It means that technical fortress at $30 failed, the institutional support wasn't strong enough, and you get out. The report frames it very clearly. You're risking less than $1 below the floor for a potential gain of over $16 to that analyst target.
When you lay it out like that, the downside is incredibly tight, especially for a stock this volatile.
And that's the core claim of the report. They say the risk-to-reward ratio for SMCI right here at the $30 level is, and I quote, incredible. You've got a really well-defined floor at $29 and this huge upside potential towards $46, all supposedly backed by fundamentals that are about to reaccelerate.
This has been a fascinating deep dive into why this analysis is so bullish on an SMCI recovery. So to quickly recap the main points, we have the huge psychological and technical importance of that $30 rejection on January 9th. That set the floor. Then we have the valuation. That PE of 24.35 compared to peers at 40x or 50x, which suggests it's deeply undervalued.
And fundamentally, it all comes back to the demand for those liquid-cooled AI racks. That demand is what supports the optimistic guidance of $10 to $11 billion in revenue. And that jump, if it happens, proves the recent miss was just a supply chain hiccup, not a fatal flaw in the business.
So with all that, what does this aggressive analysis mean for you as you're watching the market?
Well, the entire strategy really hangs on one thing. that the demand for high-end AI servers is truly accelerating, and that SMCI can actually hit that massive $10 to $11 billion number. So the provocative thought we want to leave you with is this. What other signs, what independent indicators outside of the stock price could you watch to confirm that global spending on AI infrastructure is ramping up fast enough to make that guidance a reality? Because monitoring the whole ecosystem, not just the stock chart, is how you'd really test if this investment thesis holds up.
A perfect call to action for doing your own research. Thank you for walking us through all of this.
My pleasure.